So this is the real corporation and its comparative statement of financial position. Let's start with ratio analysis. What is ratio analysis? Ratio analysis is a way to avoid the problems associated with comparing companies of two different sizes to use financial ratios. Such financial ratios are ways of comparing the relationship between two or more financial items. So there are types of financial analysis ratio. First is the liquidity or short-term solvency. Next is asset utilization liquidity analysis, debt utilization or leverage ratio, and lastly, profitability ratio. On the other hand, I am going to discuss the liquidity or short-term solvency and profitability. What is liquidity or short-term solvency? It pertains to the firm's ability to pay any immediate and incoming cash disturbance, such as payments of payables and operating costs and expenses. So this is the formula in getting the current ratio. Current ratio equals current asset of 870,828 pesos over the current liabilities of 390,508 pesos. If divided, it is equal to 2.23 or 223 if multiplied by 100. So the current ratio of 2.23:1 can be interpreted to mean that for every 1 peso of current liability, the company has 2.23 pesos current assets to pay. This result made times considered as favorable and satisfactory. It indicates that Real is able to pay their current maturing debts with 1 peso and 23 cents to spare for every 1 peso of liability they have. So it is important to remember that no single current ratio is applicable or appropriate for all businesses. Other may consider a ratio of 1:1 is satisfactory. A high current ratio does not necessarily mean that the company is able to meet current maturing debts because the firm asset is composed mainly of inventories. Inventory is considered as a slow-moving asset in terms of its current convertibility into cash. So next is profitability. Profitability. It assesses the returns earned by a business from its trading activities and investment. Profit is very important in business. It is the reward or return for taking risk and making investment. Profit shows how successful a business is. So, in getting the gross profit ratio, the formula is gross profit over net sales. So the given example here is gross profit of 799,367 pesos over the net sales of 3,007,887 pesos. So it is divided and the answer is 26 cents or 26 cents is to 1. This presents the gross profit per peso of sale. This is used as ascertain if the gross margin of profit is sufficient to cover the operating expenses and its firm desired net income. Real gross profit ratio indicates that their ability to earn more than adequate sales revenue to cover their cost of selling the goods. However, a 26% gross profit ratio means a 74% cost ratio. This relatively too high. Management must come up with more stringent cost control measure to decrease cost of sales, thereby increasing the gross margin ratio in the succeeding years. Next is net profit. net profit ratio or profit margin. The formula is net profit over net sales. So the given example here is net profit of 116,030 pesos over the net sales of 3,007,887 pesos. So the answer is 39 hundredths. The ratio could mean that 39 thousands rather. The ratio could mean that for every 1 peso sales revenue, the firm has 39 cents net income. This gauge the profitability of the firm after including all revenues and deducting all costs and expenses and taxes. Will's net profit ratio of 39% is positive. However, management should look closely to come up with measures that would increase revenue and decrease cost in order to ensure and achieve profit maximization. Next is return on assets. So the formula is net income over average total assets over 2. So given is net income of 116,030 pesos over the average total assets of 1,014,082 pesos plus 966,290 pesos over 2. So the answer is 12% or 0.12. The DuPont method equals net profit ratio of 3.9% times total asset turnover of 3.4 equals 12. This could mean that for every 1 peso asset used by the company to generate revenue, it yielded 12 cents of net income. It gauges the profitability of the firm in the use of total assets or total liabilities and total owner's equity. Return on equity. Its formula is net income over average stockholders' equity over 2. So the given is net income of 116,030 pesos. Average stockholders' equity of 415,142 pesos plus 376,630 pesos over 2. So the answer is 29%. This could be interpreted to mean that for every 1 peso of invested capital by the owner and used to generate revenue, it yielded 29 cents of net income. This ratio, just like the return on asset, is used to gauge the company's efficient in managing its total asset invested and in coming up with return to stockholders. That would be all. Thank you.